Hey traders, welcome to, that's a lot of Raghee. Welcome to Charts and Coffee. Great to see everyone. Let's get some screen share going here. There we go. All right, great to see everyone. Welcome to Charts and Coffee, gang. Happy Tuesday. Hope everyone is doing wonderfully and ready for another exciting week as we continue to journey through October. Of course, October is the month of trick or treat. Trick or treat so far. Seems like treat. I never presume that seasonals and tendencies, and just because it happened before, means it's going to happen again. We have to treat every single season of the market as something that is vaguely recognizable, but not a rerun, right? It's as it's said many, many times, it's going to rhyme. It may not be exactly the same, but it could rhyme, right? That's the old saying. And that's where we continue to be, in an environment where every single day we're continuing to assess and reassess market structure and frankly trying to find an edge. And if that edge is on a weekly, which I found a lot of opportunity on the weekly, if that edge is on the 5-minute time frame and we're day trading, so be it. One of the questions that I received yesterday, and I love this question, it was from one of my mastery members, and the mastery is mostly focused on my favorite time frame, my favorite time horizon, which is 3 to 4 days, the 3 to 4 weeks on a daily time frame. And yet, since mid-June, we've been trading almost predominantly. I think we have maybe 4 or 5 weekly time frame portfolio setups, but mostly it's been day trading, and frankly, lots of it, 4 to 6 trades every morning, pretty much 5 days a week. And the question is, are we going to get back to that daily time frame? And I'm going to basically answer that exactly how I'm going to reply to this email, which is absolutely. I really want to get back there as soon as we have an edge, as soon as we have clarity and can get the kind of follow through in a predictable manner that we are used to having in previous years, and even earlier this year, a little bit more so than what we've seen since, say, Memorial Day. And until that clarity comes back, I don't have an edge. And if I don't have an edge, I don't have a trade. No edge, no setup. Edge being literally, quite literally, that advantage. All right, gang. So just to kind of recap, look, I'm not a big fan ever of saying, because it doesn't really matter, of saying things like, well, we should expect a bounce here. I wake up every morning and I don't know what to expect. The market's going to open up and I'm going to be looking for trades. And after that, it's a blank sheet. The more that we publicly start to say, this is what's going to happen next, the less, and that's even to ourselves and any pets that might be in the room, the more that we proclaim what's going to happen next, the more the ego is going to not want to change its mind. So I don't know what's going to happen next. But what I do know is that, and we've seen this before, and I'm going to continue to rely on volume-based support. I know that we have sort of this uneven price where it looks like it was a breakdown. Remember, gang, on the other side of the lows we're seeing are numerous sell stop orders. There's buys as well, of course. For every buy, there's a sell. Where the deal gets done is the direction of the market. However, as long as that volume level, which is a standard, the deviation, right? As long as that volume support sits, I will expect support in this market. And that's pretty much it. I got a lot of folks ask me, Rog, we're retesting a level. Is this still that bottoming pattern that you talked about? Of course, it's going to take time, right? We're not going to see V bottoms anymore, gang. This is the land of 2019 V bottoms and 2020 V bottoms. Those were unusual. Tops and bottoms are not naturally V's and U's. That is usually an immense amount of central bank intervention. What is natural for the market is more of a distribution pattern, which looks like the very classic M at the top of an uptrend and W's at the end of a downtrend. So M's and W's are far more natural than V's and U's, these very sharp reversals. And yeah, I'm going to continue to look for kind of a volume and price-based W. Okay, gang, let's get to the questions. And as always, great to see everyone. Jim is asking, Jim, yeah, I think that's a very, the question is nice pre-market. Wonder how long this will last. And again, Jim, every morning I've got, because I'm going to show you all here, and it's probably at this point worthy of an intervention. These are my journals in the morning. There's 3 of them in here. One of them, so I can actually track, what I do with my time, right? What am I doing with my time? Am I being effective with it? Another one is just for trading, right? And I'll tell you what, each one of these, other than whatever I'm scheduled to do on that given day, quite literally it's a blank page, Jim. I remember that I'm a counterpuncher. I could have ideas about the market. I could have a watch list. That should be 80% of what we do, watch list building. What we're going to trade, not how we're going to trade it, what we're going to trade. And then after that, Jim, what makes this morning an uptrend? What's the validity? For me, Jim, and this is in the free trading room, for me, it's a series of moving averages that are organized in such a way that my pretty little indicators change color, like a traffic light. Green means go, right? That's it. Green grab candles, green multi. And as long as I can continue to confirm that we have an overall uptrend with that green over green, you can see the way that indicator looks. This is the multi-trend, by the way. And my mastery folks, you have this. And then those of you that are wondering, okay, Rog, volume and multi-trend, October 25, next Tuesday. I cannot believe it's right around the corner. Next Tuesday, 8 p.m. You, me, we are going to talk about volume. We're going to talk about volume-based support, using volume to set up trades like I did back in July to take advantage of that move. And what I'm seeing now, that's similar, which is why I'm not shorting in the hole. Jim, what's the validity? And as long as it's valid, we'll take advantage of it. So I love the question. It just emphasizes what's the validity. Hey there, Kevin, how are you? Bank earnings are about over. Yes, I mean, really, as soon as Goldman reports, we're done. We got that phase, that season of this earnings cycle out of the way. And that's really the kickoff. In many ways, financials are how we wake up to it's time to get in that earnings mindset. XLF is double red. Yes, it is. With multiple Darvis resistance levels overhead. And does this signify more strength to the downside? Most of our indices and sectors, Kevin, to your point, are short the rip. Can I short the S&P? Can I short the XLF? And they're much more related than not. XLF is your number 2 weighted sector within the S&P, and it's number 1 in the Dow. Can I short the Dow? Can I short the S&P? Can I short XLF? Absolutely. But let's not presume that we're going to see new lows and a continuation of that. I think that's where a lot of traders are getting burnt, where they presume taking out the June lows means a much more precipitous fall. It could be. It could be. If this market has revealed a pattern of any sort, it is not going to be the capitulation sell-off type scenario, unless something absolutely geopolitical, unplanned, unforeseen, comes out of, quite frankly, nowhere. The notion, though, that we could stair step lower, that's what's been happening. And I need to keep that in mind. However, I need to keep in mind that if I short the rip, the target is not a brand new low. So I don't have a problem with those shorts, Kevin. I'm with you. We have a downtrend. Absolutely. Absolutely. Hey there, Sam. How are you? Would like to get clarification on propulsion dots above price. Does this signify strength to the downside? Sam, think about propulsion in the same way that you would view the moving average that it corresponds with. So the green dots on this chart of the XLF, right here, if you were to have laid a 21 exponential moving average on that chart, it would look like a connect the dot. It would just connect the dot. And we know that when a moving average is below price, it's presumed to be support. When price, to your point, when that price-based indicator, moving average, exponential, simple, whatever, or my propulsion are above price, connect the dot, it's resistance. So it really is a self-correcting moving average. If you're trying to categorize, Rog, what is propulsion? It's a self-correcting moving average. It also incorporates into it the time-tested notion that moving average crosses do mean something. And we know they do. 20 crosses 50, 50 crosses 100, 50 crosses 200. We even named some of them, right? Death cross, golden cross, right? So moving average crosses are meaningful, and then propulsion takes advantage of that, but using an exponential. So whatever the moving average that it's representing is, in the green, it's a 21. So we color code them to know that greens are 21s, yellows are 13s, 8s are red. Above price action resistance, below support, just like the corresponding moving average would be. Thank you for the question. All right, Christian, good morning. What kind of price action would we need to see on the S&P before it climbs back out of the double red status? Sure, great question. First step to building anything is a foundation. Building a basing pattern is a foundation. Is a foundation always going to be found in price? No. In fact, one of the patterns that has served me very, very well since 2009, once I recognized it, is a pattern that starts with volume. Once the volume starts to show, this is where folks have dug their heels in. It's miraculous how the trend begins to shift. And then we can start factoring in price. So yes, you might say, Rog, isn't the trend a version of price? It is. It is. So if I start with volume, structure, then finally price, in that order is the way we would have to form the bottom. We have, for now, the stability and volume. The next is the trend. And then finally will be price. So I'm not to the point yet where I can get to step 2 or 3. And if you want to learn more about 1, 2, 3, these steps of volume, structure, price, we're going to talk about that again and again. I'm going to show you examples, not just from this year and not just intraday and not just end of day, weekly time frames and examples that date back to 2008, right? So we're going to take some of the most dramatic sell-offs and say, Rog, did it still follow that structure? It did. Remember last week, and I don't know if you're in the room, we had a member from the Mastery, Matt. I don't know, Matt, if you're in here. We had, I don't know if you recall, midday, late day. We had a boom sell-off. S&P had sunk. I think it was on some FOMC comment. I know, shocker. And I think it was Matt for the Mastery said, Rog, we're bottoming out on volume. He took the trade. Very nice little bounce because we had that same pattern on a 5-minute time frame. So it's that same process, Christian. Yeah, it's that same process. So what's got to happen? I've only got one step so far. And then to break the double red status, well, that's going to be a matter of that second part, that structure, 8, 13, 21, and 34, exponential moving averages. All right. Thank you for the question, Christian. I love it. Process driven. So heating oil, winter coals, BTU. I'll tell you what, my friend, I have no idea. I really am going to, so let me put it this way. Rog, what's going to get you interested potentially in, let's see if I can pull this up here. What's going to get you potentially interested in long positions seasonally? Please, and if I'm getting the question right, I'm just going to use natural gas or heating oil. And I think anything related to that narrative is going to be a seasonal narrative, right? Off-Road Bear, love this question. It sort of begs the question of, when do seasonals actually set up? Summer driving season is not in June. The season is. The trade is not. So let me put it, the season's in June. The trade's not in June. The trade dates back to April, May. Winter rallies in whatever you want to use, heating oil, natural gas, whatever it is. Those start in August. This is HEAT. By the time we get to this stage in the year, at this point within that movement, whatever it may be, natty gas, heating oil, whatever it is, remember that now we are very much weather dependent. So if we're going to look at, say, UNG, very similar pattern, right? July, August, and then it drops through summer. The only way that trajectory, and you'll see these little blips, those are typically going to correspond with dramatic storms, which we really can't foresee. And they're going to correspond with the EIA, the Energy Information Administration, kicking up what's known as HDD. I know, what's with all the acronyms, right? Heating degree days. At this stage, Off-Road Bear, it's a weather and heating degree day led rally. So it's going to be much more sporadic. It's going to happen much quicker. But the seasonal rally, when you take a look at this, it's a 10-year seasonal, right? When you look at this, you can see where we are now and what typically the trajectory is, barring those winter storms, significant winter storms, and heating degree days being elevated. In other words, we're going to need more heat. We're going to expect a harsher winter. That's what the EIA then is trying to prepare. So I hope that makes sense. All right, gang. Next up, how are we on time? Okay, we're good. All right. Hey there, John. How are you? What's pushing the markets higher? So let's talk about oftentimes what's just a simple statement of more buyers than sellers, right? What does that even mean? It's actually kind of untrue. What do I mean by that? If there are more buyers than sellers, there's more demand than supply. Let's just go back to economics 101, supply and demand. So there's more buyers. If there's more folks in a room that want to buy the thing and there's less things, price will go up. Why? Because the buyers are willing to buy at higher and higher and higher prices. So you see this escalation of price that the deal is done at. Because remember, for every buy, there's a sell. So it's actually more buyers than sellers. It's never more buying than selling because that's even. It's a matching market. Every buyer has a seller. Each buy has a sell. So it's more buyers than sellers. And the deal, more importantly, is being done at a higher level. So the question then is, why are these deals, why is the agreement to buy the S&P being done at a higher level? Well, that's when we get to news. And news is funny. It's fickle. News is as funny as fickle. Sentiment can shift with a tweet. Sentiment can shift. And I'm looking to see what the chatter is today. Thursday, Friday, and Monday was a sequence of things that we could not have foreseen, nor are they even, majority of that news was not even US based. We saw the fiscal policy within the UK take a absurd, arguably, turn. Everyone freaked out. The Bank of England, freak out, by the way, has to be defined by something. The freak out was the gilts, their bonds, started to free fall. The Bank of England said, we got this. It's our job. Fiscal policy was a nightmare. All those folks have been since replaced. Prime Minister Truss has perhaps injected some sanity into what was turning into a pretty big problem, but more so, the Bank of England stepped up and said, we'll buy the gilts. We'll buy them. We'll add price stability. We've seen other central banks do this before. U.S. equity markets are selling off. The U.S. central bank empowers the Treasury to do what? Buy stocks, buy HYG and JNK. So central banks can do this. When we have stability in the UK, you'll notice that news. If you haven't already, John, you notice that news stabilized a lot of other countries' equity markets, including the US. Now, add to that more specific US news. Financials earnings were pretty good. Johnson & Johnson, blowout number. Expectations were so bad for earnings. Disappointing. What's that old saying? If you don't expect too much of me, you may not be let down. I think that's a line from a old Gin Blossom song. It's true. You don't expect too much from me, you may not be let down. That is the theme of this earnings season. The expectations are not high. It's easier for the market to breathe a sigh of relief. And I would call this, for now, simply a relief rally. This is not an uptrend. This is not an uptrend, right? As much as I'm not calling for significantly lower lows, I feel like a bit of a minority voice here. But as much as I'm not calling for significantly lower lows, I'm not calling for an uptrend either. So just because some of us are not embracing the hyperbole of significant lower lows, I'm not going to do that until we get the earlier pattern. The question about the pattern earlier, about what's it going to take, right? Christian had that question. Same thing. So what's pushing the market higher? It's just a shift in story, John. It's just a shift in the story. And that we're willing to do deals at a higher price. When the story shifts or accelerates, that's our next leg. Target, though, overhead, it's staring us right in the face. 3,800, gang. 3,800. 3,800. And we're getting closer and closer. Take a look at what's happening from a volume perspective. Let me show you here. It's all measurable if you know where to look. Take a look. Just under the -1 standard deviation, we have peaked. And in that zone of peaking in volume, resistance in volume, we are probably going to coincide with 3,800. 3,800 is also a Darvis level. 3,800 is a major psychological level. And you can see where we are right now. We're wandering closer and closer into a volume zone. See this in the background there, that giant volume zone? We have a giant volume zone sitting back there too. That means there's a lot of size. There's a ledge sitting overhead. And that's where we are. So I hope that makes sense. Awesome questions this morning, gang. Really good stuff. And just like that, I am out of time. I saw some of the UK questions, Zane. Yes, I think that's going to, when we see the stabilization in UK, that's going to help stabilize just about every G7, G8 country. And we're seeing that already. All right. We're seeing that already. All right, gang. There is a fake me. That is not me. So if y'all see this Bitcoin nonsense, that is not me. I am up to my eyeballs in fake Raghees. By the way, as we wind down here, gang, two things. One, I will never DM you about managing money, Bitcoin, Forex. I'm not going to DM you to solicit funds. No one at Simpler is going to. There are a lot of scumbags out there parading around as us, asking you all for stuff. Tell them I said hi and to go pound sand. All right. So please don't get suckered. But have some fun with them. Really lure them in a little bit. And then drop the hammer on them. The other thing is, if you haven't already, get it in your planner. Maybe you have 3 like I do. I will see you all Tuesday, the 25th, 8 p.m. We're going to talk about volume, gang. We're going to talk about how this has been, why I'm not super bearish, why we're going to continue to take advantage of certain levels, and the clarity that opinion, we can measure that, will give us. All right, gang, have a great one. I'll see you tomorrow, same time, same station. Be good to each other.